While American economists were celebrating the dollar's so-called resilience and financial anchors were pointing to low volatility in currency markets, something extraordinary happened across 54 nations simultaneously. Not a war, not a coup, not a sanctions announcement, a decision. A quiet, deliberate, irreversible decision that won. 4 billion people made together, and which the Western financial press spent exactly 3 paragraphs covering before moving on to the next earnings report. Africa rejected the dollar? Not symbolically, not rhetorically, not in some United Nations resolution that evaporates by Tuesday. In trade settlement agreements, in infrastructure financing terms, in the currency denomination of $178 billion worth of active development contracts now being renegotiated into yuan, dirham, and a basket of currencies that deliberately, architecturally excludes the Federal Reserve from the transaction. $178 billion. That is larger than the entire GDP of Ethiopia, the continent's second most populous nation. That is roughly equivalent to 7 years of World Bank lending to the entire African continent. That is the number that should have been on the front page of every financial newspaper in the world. Instead, it was buried in a Forum on China-Africa Cooperation press release that most Western analysts apparently did not read. This is what keeps serious macroeconomists up at night. Not the headline, the mechanism. Because what is happening in Africa right now is not a story about China being generous or America being distracted. It is a story about the architecture of global monetary power being quietly, methodically, surgically dismantled, one bilateral settlement agreement at a time. And once you understand the mechanism, you will never look at dollar hegemony the same way again. Chapter 1. The Myth of African Dependency. For 70 years, the dominant narrative in Western financial institutions told a coherent, self-reinforcing story about Africa and money. The story went like this. African economies are commodity exporters with weak institutional capacity, volatile currencies, and chronic current account deficits. They need dollars to purchase imports. They need dollars to service sovereign debt. They need dollars to attract foreign investment. The dollar is not a choice. It is a gravitational field. You do not choose to orbit the sun. You simply do. This narrative was not entirely wrong. It was built on real structural facts. As recently as 2018, approximately 87% of African cross-border trade was invoiced in dollars or euros. Not because African finance ministers loved the Federal Reserve, but because commodity markets, oil, copper, cobalt, gold, were priced globally in dollars, and pricing requires a common denomination. Here is what that narrative missed. Denomination is not destiny. It is a habit, and habits can be broken when the cost of the habit exceeds the cost of changing it. The cost calculation shifted in 2022 and shifted dramatically. When the United States and European Union froze $300 billion in Russian sovereign reserves following the Ukraine invasion, finance ministers in Accra, Nairobi, Lagos, and Addis Ababa watched very carefully. They were not watching out of sympathy for Moscow. They were watching because they understood with sudden and clarifying urgency that dollar-denominated reserves are not assets. They are permissions that Washington can revoke. The Peterson Institute for International Economics published analysis in March 2023 noting that the reserve freezing action had triggered what it termed a quiet but measurable reallocation of reserve diversification strategy among non-aligned economies. That is academic language for governments started moving their money. Nigeria moved first and most visibly. In January 2023, the Central Bank of Nigeria authorized yuan-denominated trade settlement for imports from China, covering a trade relationship worth $4 billion annually. This was not a political statement. It was an accounting decision. The CNY settlement eliminated the conversion cost, reduced transaction time from 3 2 days to under 8 hours and removed dollar-denominated credit risk from transactions that had no American counterparty. Think about what that means structurally. A transaction between Lagos and Shenzhen passing through neither American banks nor American infrastructure was nonetheless priced, settled, and cleared in American dollars, paying American financial intermediaries a spread for a service they were not actually providing. The dollar was a toll booth on a road it did not build. When Nigeria removed the toll booth, the transaction cost dropped by an estimated 4% per transaction. Entrée tourne. $4 billion in annual trade, that is $327 million annually returning to Nigerian businesses and Chinese exporters. Not to Washington, China did not stumble into Africa's financial system. It engineered entry over 2 decades with a patience and precision that Western financial institutions, obsessed with quarterly performance metrics, were structurally incapable of matching. The first layer was infrastructure. Between 2000 and 2022, Chinese state-affiliated entities financed and constructed approximately 13,000 kilometers of railway, 100,000 kilometers of road, 1,000 bridges, and 100 ports across the African continent. The financing terms were not charity. They were strategy. Loans denominated in yuan, repaid in yuan, serviced through accounts at Chinese state banks. The second layer was the debt structure. A 2023 report from AidData, a research institute at William and Mary University, documented that approximately 35% of Chinese lending to African governments contained clauses that allowed collateralization against commodity assets, port revenues, mineral extraction rights, resource export streams. Critics called this a debt trap. The more precise description is a currency conversion mechanism embedded in infrastructure financing. A government, take Zambia as the documented case, borrows $6 billion from Chinese state entities to finance copper region infrastructure. The loan is denominated in yuan. Repayment is structured against copper export revenues. Zambia's copper goes primarily to China. The transaction chain becomes Zambian copper extracted, exported to China, sold in yuan, debt serviced in yuan, infrastructure maintained by Chinese contractors paid in yuan. The dollar appears nowhere in this chain. It has been surgically removed. This is not a trap in the conventional sense. A trap implies you want to escape. The architecture Beijing constructed makes staying inside the yuan-denominated system cheaper than exiting it. That is not a trap. That is a platform, and the platform now covers $178 billion in active contracts across 49 of 54 African Union member states. The most significant development of the past 18 months is the Forum on China-Africa Cooperation Commitment announced in Beijing in late 2024. $51 billion in new financing explicitly structured to support what Chinese officials described as local currency settlement mechanisms. That phrase, local currency settlement, is the technical language for dollar exclusion. It means the transaction infrastructure being built does not route through SWIFT, does not require correspondent banking relationships with American financial institutions, and does not generate the data streams that the U.S. Treasury uses to monitor and enforce sanctions compliance. The remaining $127 billion in the $178 billion figure represents existing contracts being renegotiated or restructured following the reserve freeze shock of 2022. South Africa alone renegotiated 31. $2 billion in trade financing terms between 2022 and 2024. Consider the implications of that number. South Africa is the most sophisticated financial market on the continent. The Johannesburg Stock Exchange processes transactions comparable to mid-sized European exchanges. When South Africa's finance ministry decides that dollar-denominated trade credit is a geopolitical liability rather than a neutral financial instrument, the signal it sends to every other African finance ministry is not subtle. To understand what Africa's dollar rejection costs the United States, you first have to understand what dollar hegemony actually delivers, not in theory, but in measurable, specific, annual revenue flows. The dollar's reserve currency status generates what economists call seigniorage, the benefit accruing to the issuer of a currency from the gap between the currency's face value and its production cost. For the United States, the mechanism is more complex than printing money. It operates through the persistent demand for dollar-denominated assets, treasury bonds, dollar deposits, dollar-invoiced commodity contracts that allows the U.S. government to borrow at interest rates approximately 5 to 1, 0 percentage points lower than its fiscal fundamentals would otherwise justify. That spread, applied to a federal debt now exceeding $34 trillion, represents an annual interest subsidy of between $170 and $340 billion. That subsidy does not come from nowhere. It comes from every government, central bank, and trading company in the world that holds dollars it did not need to hold, in instruments that pay below market returns because the dollar system required it. Africa's dollar rejection does not eliminate this subsidy overnight. Reserve currency transitions operate over decades, not quarters. But each bilateral settlement agreement signed in yuan or dirham represents a reduction in the structural demand for dollar assets and a corresponding, small but real, upward pressure on U.S. borrowing costs. The Federal Reserve Bank of New York estimated in 2022 that a 10% reduction in global dollar reserve holdings would increase long-term Treasury yields by approximately 40 to 60 basis points. Africa currently holds roughly 8% of global foreign exchange reserves. A full transition of African reserve management away from dollar assets, a process now underway, though far from complete, would represent roughly a 3 to 4 basis point increase in U.S. Treasury yields. Here is what those numbers mean in human terms. A 4 basis point increase in Treasury yields applied to $34 trillion in federal debt equals approximately $6 billion in additional annual interest expense. That is more than the entire annual budget of the U.S. Agency for International Development. It is approximately equal to the annual operating budget of the Federal Bureau of Investigation and Drug Enforcement Administration combined. Think about what this means for you directly. Every basis point increase in Treasury yields ripples through the entire U.S. interest rate structure. Mortgage rates, student loan rates, credit card rates, car loan rates. The dollar's reserve status is not an abstraction that matters to finance ministers and central bankers. It is the hidden subsidy that makes American consumer borrowing cheaper than it would otherwise be. When that subsidy erodes, American households pay the difference. Those who study monetary history recognize this pattern immediately. Those who do not are now learning it at significant cost. In 1944, the Bretton Woods Conference established the dollar as the world's reserve currency, replacing the British pound sterling, which had held that status since approximately 1820. The transition was not abrupt. Britain did not surrender reserve currency status in a single dramatic announcement. It lost it incrementally, bilaterally, one trade agreement and one debt renegotiation at a time, across a decade of managed decline following the catastrophic fiscal damage of 2 world wars. The mechanism of sterling's decline is precisely the mechanism being replicated today. Britain's colonial trading network had created a system in which Commonwealth nations held sterling reserves, denominated trade in sterling, and maintained banking relationships through London's financial system, the City of London performing exactly the function that Wall Street performs today. When the structural reality of British industrial and military power no longer matched the monetary architecture Britain had inherited, the architecture did not hold. It dissolved. China does not need to destroy the dollar system. It needs to build a viable alternative that is cheaper, faster, less politically contingent, and unencumbered by the secondary sanctions architecture that American financial hegemony depends on. Once that alternative exists, and in Africa, it now exists at $178 billion of operational scale, the question shifts from will countries use it to why would they not? The critical mechanism difference from the British case is speed. Sterling's decline took approximately 25 years from the end of World War II to the final collapse of Bretton Woods in 1971. The digital infrastructure underlying China's cross-border interbank payment system, combined with mobile banking penetration in Africa, now exceeding 60% in several major economies, compresses that timeline dramatically. The African financial system that China is building does not require the physical infrastructure of correspondent banking, telex settlements, and paper documentation that made monetary transitions slow in the 20th century. It runs on servers and smartphones. That is the part most Western analysts missed. They were looking for a physical alternative to SWIFT. China built a digital one. China's position in this transition is not simply that of an opportunistic lender exploiting American distraction. Beijing has invested with remarkable discipline and over a remarkably long time horizon in exactly the infrastructure required to make the yuan-denominated system operationally superior for African counterparties. The Mombasa-Nairobi Standard Gauge Railway, financed at a cost of $8 billion, reduced cargo transport time from the Kenyan coast to Nairobi from 36 hours to 8 hours. The Dar es Salaam port expansion, completed in phases between 2016 and 2022 at a total cost of $2 billion, increased container throughput capacity by 400%. The Ethiopia-Djibouti Electric Railway, the first fully electrified railway in sub-Saharan Africa, was financed and built by Chinese state entities for $4 billion and now carries 75% of Ethiopia's trade. Each of these projects has the same financial architecture: yuan-denominated financing, Chinese contractor payments, Chinese equipment procurement, Chinese technical staff on long-term contracts, and repayment structures tied to commodity export streams priced in the Chinese market. The infrastructure is not separate from the financial architecture. It is the financial architecture, rendered in concrete and steel. The African Union's agenda, 2063, the continent's long-term development framework, identifies infrastructure connectivity as its primary economic objective. China identified that objective before the African Union codified it and structured its engagement to become the default delivery mechanism for achieving it. That strategic alignment is not coincidental. It is the result of 2 decades of sustained diplomatic engagement, think tank funding, academic exchange programs, and infrastructure financing that American policy had no systematic equivalent to. The United States spends approximately $60 billion annually on official development assistance globally. China's Belt and Road Initiative committed approximately $240 billion to Africa alone over the 2013 to 2023 decade. That is a 4-to-1 capital deployment advantage in the region, now driving the most significant erosion of dollar reserve status since the end of Bretton Woods. For Washington, the cost of that gap is now becoming measurable. For Beijing, the return on that investment is now becoming structural. Here is what makes this moment different from previous periods of anti-dollar sentiment and why the current transition carries genuine long-term consequences for American monetary power. Dollar alternatives have existed before. The euro launched in 1999 with the explicit ambition of creating a competing reserve currency. The Eurozone today represents 19% of global GDP. Yet, the euro accounts for only about 20% of global foreign exchange reserves, roughly proportional to its economic weight, not transformatively larger. It never displaced dollar dominance because European financial markets replicated American ones without offering structural advantages to non-European counterparties. China's African infrastructure is different in a specific and important way. It does not merely offer an alternative denomination. It offers an alternative ecosystem, an integrated system of production, logistics, financing, and settlement that reduces friction for participating economies while simultaneously creating switching costs that make dollar readoption expensive. A Zambian copper producer whose mines were financed with Chinese loans, whose ore moves on Chinese-built railways to Chinese-built port facilities, whose shipments are insured by Chinese insurers and financed by Chinese trade credit, and whose debt service runs through accounts at Bank of China, faces an extraordinary coordination cost to re-dollarize any individual transaction. Every link in the value chain would need to change simultaneously. That is not a financial decision. It is a logistical revolution. The International Monetary Fund's 2024 Currency Composition of Official Foreign Exchange Reserves report showed that the dollar's share of global reserves had declined from 71% in 1999 to approximately 58% in 2023. That 13 percentage point decline represents approximately $2 trillion in reserve holdings that have migrated to other currencies. The pace of that migration accelerated following 2022 by a factor the IMF described in notably cautious language as statistically meaningful. Africa is not the only theater in this story, but it is the fastest moving one, and the one where the infrastructure lock-in is most advanced. Once a continent of 54 nations has rebuilt its logistics, financing, and settlement infrastructure around a yuan-denominated ecosystem, the cost of reversing that choice becomes prohibitive. That is the definition of structural change. The $178 billion currently denominated outside the dollar system in Africa represents approximately 0.5% of total global dollar-denominated trade. That number will strike some observers as trivially small. It is not. It is the number from which exponential curves depart. In 2005, yuan-denominated trade settlement globally was functionally 0. By 2015, it was $8 trillion. By 2023, it was $2 trillion and rising. The African component of that trajectory is not the destination. It is the mechanism, the proof of concept demonstration that a non-dollar trade and investment ecosystem can function at continental scale, that African finance ministries can denominate sovereign debt outside the dollar system without triggering capital flight, and that the U.S. Treasury's ability to weaponize dollar access is no longer a universal deterrent. The most significant geopolitical consequence of what is happening in Africa is not what it does to Africa. It is what it demonstrates to everyone else. Brazil, which already settled its first yuan-denominated trade transaction with China in 2023. India, which quietly maintains rupee settlement agreements with over 24 countries. The Gulf states, which are simultaneously hosting American military bases and exploring digital currency frameworks that bypass SWIFT. Each of these actors is watching Africa's dollar experiment with the attention of a scientist observing a proof-of-concept trial. If it works, if 54 African nations can reduce dollar dependency without triggering the kind of economic punishment that American financial power has historically been able to deliver, then the next phase of the transition begins. And the next phase involves economies 10 times larger than Africa's. You will not read about this in the quarterly earnings summary. You will not hear about it in the Federal Reserve's press conference. But the $178 billion already committed, the infrastructure already built, and the settlement systems already operational, they are not projections. They are facts. And facts, in geopolitics as in physics, do not require your acknowledgement to operate. The dollar's dominance in Africa is ending. The question is no longer whether, it is only how fast. And on that question, China's infrastructure investments, China's settlement systems, and China's 2-decade patience have already provided the answer.